in 2019? We're asking our money pros. We have Lee Munson, Danielle Shea, and Scott Martin. Scott, starting with you, is it going to be a good year for the markets?
I hope so. Here's the good news. And I liked your rundown, by the way, because I would add too, Trish, economic data has suddenly gotten weaker in the face of, say, this market volatility too, which is a concern as we've seen rates come down. So to me, Trish, yes, it's going to be a better year in 19 and a less volatile one, but probably not for a couple months as the market kind of sorts out where it wants to be valued. So as an individual investor, you need to take these dips as reasons to buy to hold for the long term.
I like that optimistic outlook. Lee, your thoughts?
Oh, well, the only thing I disagree with on, which really doesn't matter, is the volatility. I think it's going to persist throughout the whole year. But, you know, last Wednesday after that Fed meeting, I got my Christmas gift early, which was seeing 2,500 on the S&P 500. So we're doing buying for clients. So I agree. You got to take these dips to buy. It is going to take such an act of God to have earnings go down 20% to really get into an earnings recession to make this market go even lower. So I think the bottom line is, even if we have flat earnings growth, that's okay. Even if we have 4 or 5%, that's okay, because the market can still rise on that. That's why, you know, we think as of right now on Christmas Day, I think you've got 10% upside and a little less than 10% upside or downside. So I think it's even odds. I think you go in here, again, recessions are always going to happen, but it's really going to take a lot to get us there by next year.
I hear you on that. Danielle, curious to get your thoughts, because I look at the economic landscape right now and it feels pretty good. And I know the markets are rocky, but you've got the wage growth that I was just talking about. You've got GDP growth. You've got jobs being added. In other words, the fundamentals for now anyway, and certainly for a change compared to the last decade, they feel good.
Yes, and there are a lot of fundamentals that feel good, but at the same time, there are a lot of problems. The political instability is a huge one. Trade wars has taken our industrial stocks and our transportation stocks for a huge dive. It is going to be incredibly difficult for this market to recover if the transportation stocks, if the industrials, and if the financial stocks cannot get it together. There's just really not going to be anything to pull the market higher.
All right, but do you think that a recession is actually in the works? Because I hear a lot of talk. And in fact, I see these Democratic strategists out there almost gleeful when they talk about it, this idea of recession being on the horizon. I don't see it yet in the fundamentals, and I tend to run a little scared on these things. Is there anything that indicates to you, Danielle, we need to be worried about recession in 2019?
Well, the main thing that I'm concerned about is a high level of consumer debt, high level of margin debt. I mean, I'm seeing reports all over the place that people are buying Christmas presents on credit cards. We have a generation that has a really high level of student debt as well. And so...
by the way, the student debt's awful. But Lee, was that you saying, oh gosh, because, you know, by the way, sometimes you'd consider that a healthy sign, right? Because people are out, they're spending, they're not holding on to every penny, they're willing to go into credit card debt. And, you know, I'm not saying it's ever a good thing, but it does show you symptomatically how people are feeling about the future, and it shows a little bit of confidence, which, let's face it, we need. Lee?
Every recession starts with a lack of consumer spending and a housing crisis and all these things that make people spend less. We don't have any anecdotal evidence to suggest that's not. You know, debt's bad, debt's bad. This is not the Dave Ramsey show, people. Debt's good. It's how you leverage. It's how you make more profits at the late stage of a bull market. So I like that people are positive about the world. And I think that when you see what's happening over the last, 6 to 8 weeks in markets, this is about investors being moody and investors being disappointed that we're not going to see 20% earnings growth next year. And you can see those those industrials, all those cheap stocks that got beat up in a matter of months. You can see that stuff roar back. Beware.
Scott, investors are moody, but let's not forget there's also a lot of machines, right? And algorithms doing the trading. And, you know, when you hit certain levels, a lot of those algorithms kick in. So it's investors, but isn't it also the sort of nature of trading these days where you get a little more volatility?
Yes, sadly. I mean, Fed Day last week was certainly an example of that. I mean, that was a really steep slide, one of the fastest I've seen this year with all the volatility that the machines were hitting around the ping pong ball with. And listen, I guess I'm sitting here disappointed because Lee mentioned earlier, you know, he got this early Christmas gift, which obviously I guess wasn't mine. Sorry about that, Lee, that I sent you. I did put that on a credit card, by the way, because he's right. I mean, credit is extended to consumers, to businesses for a reason. And with rates down as they are, Trish, as we've seen over the last couple months, was kind of curious if things are okay economically, why the 10-year note, say, has fallen from 3.25 to 2 and change, you know, 2.7, 2.8, because that to me tells me something is weakening somewhere in the economy. So as credit is getting extended, that's great, but some of these businesses and consumers could be getting over leveraged.
All right, we're watching it all. Thank you so much. Good to see you. Before we see everyone the ball dropping on this year, we are hearing a lot of name dropping, shall we say.